A wise man once told me, you don't need money to buy your first investment property. You need access to money to buy your first investment property. And in today's video, I'm going to tell you exactly how I and my clients fund their investments here in Bryan and College Station, Texas. Guys, if you don't know who I am, my name is Greg Schwartz. I'm an agent and investor here in town. I help clients every day buy properties. And of course, I am buying my own. So how do we fund those properties? That's what I'm going to share with you in this week's video on my channel, Investing in Bryan and College Station, where I help you grow your wealth through real estate in my favorite towns of Bryan and College Station, Texas. Guys, like, subscribe, and enjoy this video on funding your first or next investment. Guys, in this video, we're going to be talking about taking on debt. It's important to note that when you take on debt, you're also taking on a level of risk. If you talk to Dave Ramsey, any amount of debt you take on is risky. So know that the more debt you take on relative to the value of the property, the more risk you are inherently taking on, and only you can judge what your risk tolerance is for your investment portfolio. So I want you to keep that in mind. On a similar note, I'm going to recommend some creative financing, but there's one creative financing that I don't recommend, and that's subject to. Subject to is where you take ownership of the property through the title, but you don't take on the mortgage, meaning the mortgage, the loan, stays in the seller's name. There's a lot of reasons why this can be an issue. One, the bank can call that note due, which means that seller is now on the hook for that debt. Then you have to pay the seller. It just becomes a quagmire that I personally think is too risky. If you want to know more information about the risks involved with subject to, I have a link in the description below to 2 podcasts done by Bigger Pockets about those risks. But guys, there's a lot of other great ways to fund real estate, and I'm about to share those with you right now. When you go to get bank financing and you just walk into any given bank and you say, I'm looking to buy an investment property, they're going to probably point you towards a conventional investment loan. This is a great product. You're looking at 20 to 30% down. You're looking at a loan that has lower interest rates, relatively speaking. It has a 30-year amortized note. It's very secure, but it's backed by you, the borrower. Now, eventually you'll get enough of these loans, it'll be more difficult to get a loan, or you might be in a position where you're buying in an LLC. This now makes it more difficult to get a conventional loan. So once you run out of the conventional loan options, the bank is going to point you towards the back corner of the bank, the dark corner of the bank, the commercial lending department. Now, it's really not that scary, and a lot of my loans are commercial loans. What does that mean? Well, the good news is it means that the loan is no longer based on your income, but it's based on the property's income. The commercial lending department in a bank is lending to your property as if it's its own business, so that business has to create enough profit to cover the debt that the bank is giving you. So you are no longer the most important piece of that puzzle when it comes to approving the loan, the property is. And that's overall good news. So what's the bad news? Well, generally speaking, your commercial loans, the terms are not going to be as favorable. For example, you're probably going to have to put down 25 to 35, even 50% down. You're likely also going to have a shorter amortized period. Expect something between 15 and 20 years. And lastly, your interest rate is probably going to be slightly higher. I usually expect it to be about 1/4 to 0.5% over what I can get on the conventional side of a bank. Now, there is one more option, and actually it's my favorite option when it comes to getting a loan from one of these banks, and that is an owner-occupied loan. I know, wait, we're talking about investment properties, but if you're willing to live in a house and either rent it out or eventually turn it into an investment property, you can get the best loan products known to man, particularly here in the United States, particularly here in Texas, and that is an owner-occupied loan. You can use low down payment products. There's low down payment conventional loans as low as 3% down. There's FHA loans as low as 3.5% down. And if you are a proud veteran or active duty service member, you can pay 0 down to buy your house, move into it, either house hack it, I have a whole video on that, link right here, or just turn it into a rental when you move out. All of those are great options, and honestly, if I have to choose between all of my options as an investor, the owner-occupied loan is the way to go. So why am I outside of this bank? Why am I outside of Extraco Bank? Well, I want to highlight them because they have been a great resource for me when it comes to growing my portfolio. As I mentioned, my commercial loans are with Extraco. Extraco is a regional bank, and I was able to build a relationship with them that was able to help me grow my portfolio in ways I couldn't have otherwise done. So I am a big fan of Extraco and the folks that work here. They are very friendly and very helpful when it comes to finding ways to help you buy your next investment. So what's the catch with the owner-occupied loans? Well, you're gonna have to live in the property for at least a year. If you don't, that's called mortgage fraud, and they'll send your ass to jail or fine you like $10,000, and nobody wants that. So if you are willing to live in a property, either house hack it or live in it a year and then turn it into a rental property, getting a owner-occupied loan is a great way to go. Let's say you can't get the loan you want from the bank. Your other option would be to get creative. Now there's 3 creative strategies that I recommend, and that is hard money, private money, and then seller financing. Behind me is a house I bought with creative financing, and I was able to get $120,000 of the $135,000 for this project all lent to me at a pretty low interest rate, real favorable to my project. So let's start off with the first creative, and that's gonna be hard money loan. Now, hard money is similar to going to a bank, but instead of going to a bank to lend you the money, you go to a non-bank institution. This is a company whose business it is to make loans. Now, they're gonna lend to you based on the after repair value of the house in most cases. That's really advantageous. If you are taking on a heavy value add project, they will give you, based on what the house will be worth, some percentage of that. So let's say this house behind me is worth $200K finished. They might lend me $150,000. That could cover the purchase plus the rehab. You see how in that case, I'd have no money out of pocket to get that deal done. The downside to hard money is that usually the interest rates are pretty dang high. So you're looking at 2, 3, or 4% over quote unquote bank interest rates. And it's also gonna be a shorter term loan, meaning that that loan is gonna mature and you'll owe the balance usually somewhere between 6 to 18 months. At that point, it's expected that you'll refi into a bank loan. The next option I would recommend would be private money. That's actually how I got the house behind me. I went to a family member and said, hey, I have this house that I want to purchase. I want to offer cash. I would like to take on your money to be able to make that cash offer, and I'll pay you back based on these terms. The great part about private money is, one, it's very negotiable. The terms, the fees, all of that's very negotiable. So I was able to get interest only on this house and enough money to cover the purchase price plus a lot of the rehab. Now, the downside to private money is you have to find those folks and earn the trust of those private individuals who are lending you the money. You see, this isn't like hard money. They don't advertise it. You can't just look them up on Google. This is probably folks you'll find at a real estate investor meetup or friends and family that have extra funds they're willing to lend to you. The last creative strategy is owner or seller financing. That's when the seller lends you the money via the equity in the house. You see, if they own the house outright, you can buy it from them, and rather than paying them the full lump sum up front, you can pay them the same way you would pay a bank every single month. The other cool thing about seller financing is, again, just like private money, it's all negotiable. You can have a 10-year amortized loan, a 20-year amortized loan, shoot, a 40-year amortized loan, an interest-only loan. You can have a loan that balloons in 3 months, 5 years, or 30 years. Honestly, it's all up to you and the seller to make that determination. That's what I love about the creative space. What you have to watch out for, though, is you want to make sure that you do everything above board. I always recommend that you have a deed of trust. That means that you're going to file paperwork that allows the lender to foreclose on you if you don't pay on time. And of course, you're going to have a promissory note written out by an attorney so that there is no question about what exactly you promised each other. Hey, I make this payments, you're gonna provide me this amount of money, I have this much time to pay you back. All those terms are written out in that note so that if things get weird, you can fall back on that contract. All in all, I really like creative financing as a way to buy a house with less money out of your pocket. But again, the higher leveraged you are, the more risk you take on. So make sure you know what you're getting into and your numbers are super tight. Another great option to finance your first property is through partnerships. And the beauty of partnerships is really just like creative financing. It's just a matter of you negotiating with your partner in terms of how much money you put into the deal. You might be able to put less money into the deal if you find a really good deal, or if you're willing to put in the sweat equity. But know that if this is your first deal, you might have to overcome the fact that you don't have experience. So don't be surprised if your partner pushes back and says, hey, you've never done it before, I'm not willing to put in all of the money. But even taking a smaller slice of the pie or putting in some money into that first deal is worthwhile, because once you build the experience, your second and third deal, you should be able to put less money into that partnership. You see, this stuff is going to compound on itself. So I usually recommend find a partner that trusts you, someone that knows that you have the work ethic, that you're going to do what you say you're going to do. Partner with that person on the first deal. Take even a smaller cut of the partnership, but then when you go to the second one, the third one, you'll get more money, it'll be more lucrative, and you'll be able to grow your portfolio. As always, partnerships can be risky, so make sure you have your partnership agreement written out, ideally by a lawyer, so that all the contingencies are spelled out, exactly what's gonna happen step by step. You agree to all that ahead of time, so if things do get ugly, no one is gonna argue over what you guys agreed to and how that partnership's gonna end. Did I miss anything? I think I covered most of it, but maybe I missed a way that you've structured a deal. Maybe you really like subject to, or maybe you had a bad experience with a seller financing deal. I want to hear all about it in the comments below. Make sure you let me know what happened and what we as a community can learn. Guys, I'm going to keep putting videos like this out every single week, so make sure you like and subscribe to my channel. And as always, until next time, you guys, take it easy.